If you are retired or close to retirement and you are wondering what your investment portfolio should actually look like, you are not alone. Today, I'm going to show you a complete layered portfolio from super safe cash and government bonds all the way up to leveraged ETFs. And according to your situation, you will be able to tweak and build the optimal portfolio. I'm also going to show you some rules of thumb that you can use to build the optimal investment portfolio for a retiree. And you heard well, I talk about leveraged ETFs, and I must be absolutely mad and crazy for suggesting leveraged ETFs for someone who is retired or about to retire. But stick with me because this video is a masterclass on how to build a portfolio for retirement. Who am I? My name is Henry. I've been investing for the last 20 years and I myself retired at the age of 39 in Hong Kong, which is one of the most expensive cities in the world. And in this video, I'm going to show you everything you need to know about retirement portfolio. And let me start by sharing some slides with you. Of course, each person is in a very different situation. So there is no one size fits all when it comes to building a retirement portfolio or any portfolio really for any phase of your life. Because, I cannot come like many influencers do and tell you, hey, invest in A, B, and C, and D, invest in Bitcoin, invest in Apple stock, Nvidia, and XYZ ETF, and you are good. No, it really depends on your personal situation. And your situation is very, very individual to yourself, right? Because different people have different time horizon, different spending levels, different risk appetite, different life goals, different tax situations depending on where you live. You have the different size of your existing savings and portfolio. Of course, if you have $100,000, you should invest differently from someone who has $1 million or $10 million or $100 million. More money you have, the more flexibility you have, of course, to invest. Some people might have some side income, like you might be retired, but still do some work or a part-time or having some social security. Others might not have anything like that. And there are always other factors such as estate planning, health conditions, and so on. So don't let ever anyone coming to you, even a financial advisor, and tell you should do XYZ without actually studying your current life situation, okay? So, saying this, what are the different investments that you can include in the portfolio? So now I'm going to show you many different assets that you can include in the portfolio. All these assets are in a basket of productive assets. They generate yield, okay? And you can allocate them according to your risk profile. I'm going to show you later in the video how to build a portfolio with all these assets, how to give different weights to these assets, okay, according to your specific situation, okay? But let's get into it. So what are these different investments that you can have in your portfolio? Start with cash and cash equivalents. They are very low risk, very stable, right? And I would not advise you to keep the money in cash, unless, like, of course, the money that you need to spend for the next 1 or 2 months. Much more convenient to have it in cash, okay, USD or whatever is your local currency. But you can also have these cash in ETFs such as SGOV, SGOV, which is the iShares 1 to 3 months Treasury Bond ETF. And that pays every month into your account 3.5%. At the moment, 3.5%. A few months ago it was 4%. But this is like a no risk because it's fully backed by the US government and it pays 3.5%. Okay. Maybe if you have a bank account that is like a savings account that pays something similar, it might be good. But I think most banks at the moment pay less than 3.5%. Then, okay, let's go up on the risk. Every new investment that I'm going to talk about is a little riskier than the previous one. After that, we have bonds and bond ETFs. The Vanguard Intermediate Term Corporate Bond ETF and the iShares 20-year Treasury Bond ETF. These ETFs, these bond ETFs, pay between 3.5% to 5%, and they pay usually either every month or every quarter. Okay, now these ETFs, okay, full disclosure, they will not give you a huge performance. Usually the returns are pretty flat. Most of these ETFs that I show you here, they are not to grow your portfolio, it's just to keep stability in your portfolio. Because if you look at the returns of these ETFs for the last 10 years, they barely move. So the returns are not good. These ETFs are more to give you stability rather than performance, okay? If you want performance, you need to invest in stocks because ETFs are not good to grow, okay? They're just good to give you a stable income in the form of dividends or coupon in this case. Next, we have dividend ETFs, okay? Dividend ETFs such as the Schwab US Dividend Equity ETF, the Vanguard Dividend Appreciation ETF, and the iShares Core Dividend Growth. Okay, these dividend ETFs invest in stocks of companies that pay high dividends. Usually companies that pay dividends are companies that are fairly large, that have been around for many, many years. They have a big market share, so they pay dividends. It might be, for example, Coca-Cola, McDonald's, Procter & Gamble. There are many big, large companies that are very well integrated in the market and they pay dividends. Now, dividend ETFs will perform better than the bond ETFs over prolonged periods of time, but they don't perform as well as regular index ETFs. Why? Because companies, traditionally, when they pay dividends, actually the stock price declines a little bit. If there is a company that is going to pay a 5% dividend, usually that comes at the cost of a little decline in their stock price, okay? So there is no free lunch when it comes to investing, but still adding dividend ETFs can give you, again, that side income, okay? Every month or every quarter, you receive that money in your bank account, 3, 4, 5%. And if you are looking for dividends, this feels good, okay? I'm not having into account here, taxes and so on. I'm not a tax specialist, and you might be watching this video from different countries, so I'm not going to talk about taxes. Some countries, they have high taxes for dividends. Others, dividends don't pay any taxes. So please check with your accountant or a tax expert, okay? But what else after dividend ETFs? After the dividend ETFs, I would put the broad sector and index ETFs. These ETFs might also pay a little bit dividends, but usually it's closer to 1% a year, okay? And these ETFs include the VOO and SPY, the Vanguard S&P 500 ETF, the QQQ Invesco QQQ Trust, and VTI, which is the Vanguard Total Stock Market ETF. These ETFs over the last 10 years, they will have triple or quadruple your money, so not bad at all. They give you exposure, in the case of the S&P 500, to the 500 biggest companies in the US, which are already very diversified. Why? Because if you are exposed to the 500 biggest companies, you are exposed to from tech, healthcare, insurance, financials, utilities, energy companies. You are very diversified across many different sectors. Second, these very big companies of the S&P 500, they generate revenue from all over the world. In fact, on average, 40% of the revenue of the S&P 500 companies come from other countries other than the United States. So you end up kind of already being geographically diversified. If you invest in a VOO or SPY or QQQ, for example, you get exposure to Apple. Apple sells iPhones all over the world, right? So this is just a small example. Also, in these S&P 500, in the QQQ, NASDAQ 100, you are also exposed to REITs, so we are also exposed to the property market, to construction market. So we are exposed to many, many sectors. So I would say that investing in the S&P 500 or even NASDAQ 100, you already get pretty diversified. Personally, I will put most of my portfolio into these index ETFs, but again, each person has a different situation and you can allocate differently, of course. After that, we have sector ETFs. If you are bullish in certain sectors, such as utilities, financials, technology, healthcare, energy, real estate, or small and mid cap, you can allocate a part of your portfolio into that specific sector. The problem with sectors is that they are very cyclical, right? Now energy is doing well because the oil prices are high, and maybe for the next 2 years it will not do so well. Healthcare recently is not doing very well because the government, US government, cut many healthcare spending, but maybe the next government will implement more healthcare spending, Medicaid, Medicare, and so on, and maybe healthcare will go up again. So if you believe that health or any of these sectors will perform better because maybe it's your area of expertise, maybe you are a healthcare professional, for example, and you know because you are an insider that health will do better in the future, maybe you can add those ETFs to your portfolio. Still, a sector ETF should be a smaller portion of your portfolio. It should not be the majority of your portfolio. Then we have leverage ETFs. And again, you must think that I'm absolutely crazy to talk about leverage ETFs. But there is a good reason why I'm talking about it. It's because the math behind the leverage ETFs shows us that they give us better risk-adjusted returns. What's these better risk-adjusted returns? Better risk-adjusted returns simply means that the returns that you get for each unit of risk is bigger, larger, okay? So maybe you are risking 1 unit of risk, okay, but you get 2 units of return. Usually risk is measured in volatility in this case, and leverage ETFs are more volatile, yes, but the returns are also more juicy. I will show you some charts in a minute. In terms of leverage ETFs, you have SSO, for example, which is 2 times the S&P 500. QLD is 2 times the QQQ, the Nasdaq 100. UPRO is 3 times the S&P 500, and so on and so on, okay? And then finally, you have individual stocks. Again, if you are retired, you want to stimulate your brain and you want to start picking some stocks, studying some stocks, please go ahead. Personally, I invest, every time I invest in a new stock, and I have many stocks and my stocks are performing very well. Every time I invest in a new stock, I allocate 1% of my portfolio into a new stock. So if you are retired potentially and you invest 1% of your portfolio into a new stock, and maybe you buy 10 different stocks, allocating 10% of your portfolio to 10 different stocks, it's not a big deal if some of those stocks in the meantime don't perform so well. Typically, the best investment strategy when it comes to stocks, again, is the buy and hold strategy, okay? Let your investments compound, okay? You look at the best companies out there, the best returns really come from buying and holding, let it snowball, okay? And it's okay if you allocate a small percentage, but if you are retired, again, don't go grab your entire retirement savings and put like 50% or 100% of it into one single stock. That will be extremely risky and a total gamble, okay? We need to have investment strategies that keep us stay in the game, and will not bring you to bankruptcy. Okay, now I want to show you some charts of the performance of these investments that I just talked about, okay? And this is the performance for the last, I think this is like 3 or 5 years. I think it's 5 years for most of the charts. And you can see here the performance of the bond ETFs, okay? Bond ETFs don't give you huge return, but they are usually significantly less volatile. Then you have the dividend ETFs, which over the last 5 years returned 50 or 60 something percent plus dividends. Then you have the index ETFs, such as VTI, VOO, and QQQ, which over the last 5 years returned approximately 100%. So you have doubled your money in 5 years. Not bad, right? Then you have here the sector ETFs. As you can see, some sectors did very well. XLE is for energy, XLK, it's a tech ETF. So they did very well, right? More than double your money. But if you have invested, for example, in XLRE, which is the one at the bottom, you will have returned in 5 years only 17%. XLRE is a real estate ETF. So again, these are very cyclical. And then you have here some leverage ETFs, and you can see that almost all these leverage ETFs return more than 100%, except FAS, which is financials, SSO, UPRO, QLD, TQQQ, and TECL delivered significantly more than 100%, some of them returning 200 or even 400% over this 5-year period. So it can give you like really good returns, but they are also really volatile. But again, if you invest a smaller percentage of your portfolio, let's say 5% into leverage ETFs, okay, and over a period of 5 or 10 years, these ETFs can go up 500, 1,000% or even more. So they can really, those 5% that you invest into it can give you really very interesting, upside and a little boost or a big boost actually into your portfolio. Okay, but what allocations should you use in your portfolio? Well, that will depend into many different factors. The first is time horizon. If you have a short time horizon, you should not take risk. If you have a long time horizon, then you can indeed use more risk a bit more, because higher time horizon dilutes volatility, okay? Something might be volatile in the short term, okay? And if you are depending on that money and you invest in something that is volatile and it crashes next month like 20%, you need to buy a car or you need to have money for some medical expenses, and now your volatile asset is down 20%, you are in a bad position, right? But if you are thinking about, only using that money 5 or 10 years from now, volatility is not a big deal. And I will show you exactly why on the next chart, okay? But if you need money in the short term, I'll definitely put it into very low risk or no risk things, okay? Any money that you need within 2 or 3 years, I would put it into SGov, the Treasury Bill ETF. In money that you need in medium term, like 3, 4, 5 years, I'll put it into bond ETFs that have also lower volatility and pay that coupon, that dividend every single month. What about S&P 500 and index ETFs? Well, I'll put probably a good chunk of your portfolio. Let's say all the money that you only foresee to need in 5 years or longer, I'll put into index ETFs or slightly riskier investments, okay? But only money that you only foresee to need in 5 years or more. Why 5 years or more? Because the S&P 500 has been positive in 5-year periods, has been positive 93% of the time, okay? In this chart, you can see that in the short term, well, if you invest in the S&P 500 for 1 month, you have around 63% probability of being positive. So this means that you have 37% probability of being negative. So you cannot risk putting your money in the S&P 500 because you have almost 40% probability of losing money. But 1 year, you now have 77% probability of being positive. In 5 years, you have 93% probability of being positive. Okay, I can deal with this risk. 93% probability of being positive, and usually within 5 years, you can easily double your money by investing in the S&P 500. Of course, not guaranteed past performances, not guaranteed of future results, but you get my point here, right? The longer the time frame, the lower the risk that you take. And what else should you think about? Okay, sleeping well at night is more important than anything else, okay? So if you are more risk averse in putting your money into riskier investments, you don't sleep well at night and you are constantly checking your phone to check the price of the stock market, just don't do it. Just do something more safer, okay? But if your lifestyle allows you and your savings allow you to allocate some to index ETFs, I'll definitely do it, okay? Because historically, it has been very good over the last almost 100 years. And also, in the US, the S&P 500, you have the biggest companies in the world, the best performance, the US is likely to continue to be the dominant economy in the world, and it will perform well in the future. Now, other things that you should use to decide your investment decisions. Existing income should be also accounted for your decisions, because let's say you have Social Security, you have a part-time job, you are paid for as a consultant. I don't know. People might be retired and still have some kind of income coming from business, from consultancy, from social security. So if half of your expenses can still be paid by, your part-time job, your side gig, maybe you are not so reliant. You are not 100% reliant on your investments, and maybe you can risk a little bit more, right? Then you need also to have into account your withdrawal strategy. This is what you usually call the 4% rule. So according to the 4% rule, there is lots of research and academic papers that show that if you withdraw 4% or less from your investments every year, you can, in most cases, live off of your investments for 30 years at least. So this is just to say that if you are depending on your investments, you should try not to withdraw more than 4% a year, okay? Because if you withdraw more than 4%, you'll reduce your likelihood that you will still have money in 30 years from now. Okay, finally, I know this video is getting very long, but I hope it's useful. But the last thing that I wanted to talk about is how will the portfolio look like? Okay, so imagine that you have $1 million, you are retired, you spend $50,000 a year, and you still have some social security, receiving a social security check. I don't know, you're receiving $1,000, $2,000 a month, or you have a little bit of side income. If I was in your place, how would I invest? What would be like a portfolio, model portfolio? Again, each person is different. You might have different goals, different risk appetites, different time horizons. So don't copy what you see here. I just want to give you an example, okay? But I will put something like this. I will spread this $1 million. I will put maybe $150,000. So it's money that I need for 3 years into ASCOF. Okay. Then I'll put $300,000 into bond ETFs, such as the VCIT and TLT. These bond ETFs are less volatile, and they also pay 3, 4, 5% a year. Not bad. And then I will allocate approximately $200,000 into dividend ETFs, such as the SCHD and VIG. You will receive every month that little dividend into your account. And then $300,000 I'll probably allocate to index ETFs, such as VOO and the QQQ. This can perform quite well in the long term. And then I will allocate a small percentage, like $50,000, into leverage ETFs and individual stocks. Individual stocks can be fun, and if you are retired, you want to have some fun also, right? So I'll probably do that. And leverage ETFs should be only a long-term strategy. Don't speculate in leverage ETFs because it's very hard to time the market. But leverage ETFs, a few $1,000s invested in leverage ETFs can give you really outsized returns. Let me give you a cool fact. Did you know how much do you think you have to invest 15 years ago into TQQQ to now have $1 million? Okay? To now have $1 million from your TQQQ 15 years ago investment, how much would you have to invest? Did you guess $100,000? No, less. 50? Nope. 10? Nope. $3,000. $3,000 invested 15 years ago into the TQQQ will now be $1 million. That's why I kind of like to sprinkle a little bit of leverage ETFs, because even a small allocation can turn into $1 million into 15 years. And that's not little money for most people, okay? The utility that you get from this kind of investment is quite good. Okay, guys, I know this video was quite long, but I hope it was useful. I'm always talking about how to retire early, how to fast forward your returns on my Henrique Wealth Academy. Check the link in the description of the video. And if you enjoyed this video, please give it a like and subscribe. It will really help the channel, and it will also help you, perhaps, because it will suggest more videos like this to you. All right, I'll see you soon. Bye.